for the purpose of the webinar, because we're talking about financial aid, we're only going to focus on private loans. The first loan that we're going to talk about is the parent loan for undergraduate students. This is an opportunity for parents to take out a loan from the federal government to fill that remaining need. Now, oftentimes, schools will list this loan on your award letter. So there's two things that we need to understand. On our award letter, if the parent loan for undergraduate students is listed as an option for us, it does not mean we have to take it. The school is just letting us know it's an option. And then the second thing that we need to know is just because it's listed doesn't mean we're going to receive it. This is a credit-based loan. So it might be listed on your award letter so that the school can make you aware of the opportunity to receive it, but it doesn't mean that you're going to receive it because it is a credit-based loan. There's additional paperwork and application that you have to complete to see if you're actually approved for the parent loan for undergraduate students. The current interest rate is 7.9%. And again, it's there to bridge the remaining need after you've exercised all of your other financial aid. There's an origination fee tied to the parent loan for undergraduate students. That's 4%. So if you take out a $5,000 parent loan for undergraduate students, it's going to cost you $200 to take out that particular loan. Now, the other thing about the parent loan for undergraduate students is that payments on this loan begin 60 days after the first date of disbursement. So while your freshman is still unpacking their boxes and getting settled into their first semester of college, you will already begin making payments on this loan. Now, I will let you know that you can request deferment. However, in many situations, that information isn't readily available out there. And so if you do take out the parent loan for undergraduate students, make sure you ask about requesting deferment on this loan. And deferment means while your young adult is enrolled at least half-time in a degree-seeking program, that you do not have to make any payments at all as long as they're enrolled at least half-time. If you request full deferment, again, you don't have to make any payments while they're enrolled, but you can make payments if you want to because there's no prepayment penalty. And then another unique factor on the parent loan for undergraduate students is that dependent students whose parents are denied a parent loan for undergraduate students could now qualify for additional funds through the Stafford Loan Program that we talked about earlier. So several slides back, we talked about the Stafford Loan, subsidized and unsubsidized. That's available to most all students. And if a parent applies for the parent loan for undergraduate students and they are denied, the student can now qualify for the higher limits available to them. All the student needs to do is take the denial letter for the parent loan for undergraduate students to the financial aid office, and the financial aid office can adjust their award package to create more opportunity for the student to receive the Stafford loan. In addition to the parent loan for undergraduate students, there are also private loan options available for you. When we are researching our private loan options, there are several things that we need to consider. And this particular slide, we're probably going to spend the rest of our time just talking about this particular slide because private loans work so much differently than many other loans that we would typically take out as it relates to car loans or mortgage loans or even credit cards. Private loans, they are all across the board with the various characteristics of a private loan. So when you're researching your private loans, the first thing that you need to consider is the rate. And the reason we're going to spend a few minutes talking about the rate is because the rate can come in two different types of indexes. It can come under the prime index or the LIBOR index. LIBOR is an international index that stands for London Interbank Offer Rate, and typically LIBOR runs about 3% behind prime. So currently, the quarterly prime rate is 3.25%, where the quarterly LIBOR is 0.26 right now. So prime is at 3.25, and the monthly LIBOR is at 0.26. So it's important that you know which index the lender is using, because the next question that you need to ask is, what is the margin? What's the percentage that's being added to my index? So if I tell you that my loan is prime plus 2%, then you know that prime is currently at 3.25 plus 2%, so your loan would be 5.25%. Or if I tell you LIBOR plus 2%, now it's a 2% plus 0.26. So it's a significantly different interest rate that you're paying on your student loan. And many student loan rates are expressed based on the index plus a margin. So it's important, again, that you understand the difference between prime and LIBOR, and that LIBOR does typically run about 3% behind prime. Then the next question that you want to ask is, what is the floor rate on my loan? It's common for lenders to put a floor rate on their private loan. So if I tell you that my interest rate is LIBOR plus 3%, that might sound extremely attractive to you because now you know that your loan is 3.26%. But then I tell you that there's a floor of 8. What floor means is that the rate will never go below that expressed rate. So it'll never go below, in my example, 8%. You will always be paying at least 8% on that loan. So again, as it relates to the rate, what index is being used, what's the percentage or the range of percentages that you can add to my rate, and what is the floor rate? The next category that you want to discuss with any private lender is fees. What type of fees are tied to this private loan? It's very, very uncommon for a private lender to charge an application fee. Typically what will happen is they may charge an origination fee. And origination fees can run between 0 and 10%. On average, they're about 3%. And as we discussed in the Parent Loan for Undergraduate Students, an origination fee is a cost that the lender charges to process the loan, to originate the loan for you. So if you've gone through your monthly budget and you've figured out exactly how much you need, and let's just say, again, you need $5,000, and then you're charged an origination fee, your budget has just been blown up because you know you need $500 a month or $5,000 over the course of 10 months, and then again, if they charge you an origination fee, whatever that origination fee might be, it can blow your budget by $25 or $50 a month. So it's just really important that we plan accordingly, and if they charge an origination fee, we want to calculate that into our overall need. And then the next thing to ask is repayment terms. We all know that standard repayment terms on a car loan is 5 years. We have a few lenders that go as low as 3 and some up to 7, but standard we know on a car loan is 5 years. Most of us know that standard repayment terms on a mortgage is 30 years. When it comes to student loans, the repayment terms vary greatly. They can go as low as 7 years up to as high as 35 years. And it's really important that we understand up front what it is that we're getting into, because typically when a student's in school, if we are in deferment, we're not necessarily thinking about repayment. So if you borrow $5,000 a year over a traditional 4 years, you just need to be sure that when your young adult does graduate from college, that you're able to pay back $20,000 over a 7-year period. And again, these are things we might not think about up front because in many cases we may not be paying anything until the student separates from the school. So just find out what your repayment terms are and make sure that whatever you are forecasting that monthly payment to be, that you'll be able to do it within the terms that are being provided to you. Also, borrower benefits, the whole what's in it for me's. Borrower benefits are very common to be listed from a lender, and it's their way to create an attraction around their product. Borrower benefits are a great opportunity for families to save some money. It's just really important, just like with anything else, that we understand what the borrower benefit is. We understand what we have to do to qualify for the borrower benefit, and then we also understand what we need to do to ensure we are not disqualified from receiving the borrower benefit. So again, just make sure you see everything in writing and that you clearly understand what's involved with the borrower benefit and how to receive the borrower benefit. And let me give you an example. A borrower benefit, the lender might state that when your loan balance reaches $500, that they will forgive the remaining $500 of the loan. So that might sound like a very attractive benefit to many families because they know when their loan balance gets down to $500, they're done. They don't have to pay anything more beyond that, below that $500. So that's a great borrower benefit, and it looks wonderful. However, you could potentially be excluded from that borrower benefit if you are late on just one single payment. You could lose the opportunity to qualify for that borrower benefit. And so again, there's nothing wrong with borrower benefits. They're a great opportunity to provide additional assistance or again, benefits to the families. Just make sure you understand what the borrower benefit is and what you have to do to qualify for the borrower benefit and what could potentially disqualify you from receiving the borrower benefit. Next, with private loans, most of them are going to require a co-borrower. In most cases, the co-borrower can be anyone that meets the lender's criteria. It doesn't necessarily have to be mom or dad. But what's unique about private loans, again, is each lender has different qualifications for their particular programs. So some lenders might take into account the co-borrower's credit score. They might take into account debt-to-income ratio, and some lenders may even take into account the actual school that the student's attending. It's just going to vary from lender to lender to lender. So it's important you understand what your co-borrower options are, because if you have more than one adult that's willing to be the co-borrower for the student, you're going to want to pick the adult that best matches the highest quality of that lender's qualifications to make sure that they're the co-borrower so that you get the best possible interest rate. And then finally, with private loans, we need to make sure we're clear on what our payment options are. Historically, when you would take out a private loan, and some of you on the line tonight may be aware of this, when you've taken out a private loan, you were able to have your loan in full deferment. There was absolutely no payments due while you were in school. You didn't have to pay anything at all until you actually separated from the school. But times have changed. Over the past couple years, many lenders are now requiring a good faith payment, and it might be $25 a month or $50 a month, or they're requiring that you make any payment, or they're requiring that you make any interest that has accrued that in that given month towards your loan. So what's important here to understand is that you just need to ask what your payment options are, because if you were expecting to be in full deferment and then all of a sudden in September you receive a bill for $50, again, it might surprise you a little bit because you may not have calculated that into your current monthly budget. So definitely ask about your payment options. Full deferment is an option. Prepayment penalties, you want to ask about prepayment penalties. So if you can be in full deferment and you make a payment, are there any prepayment penalties? And then, of course, find out if you're in full deferment, what happens to the interest if you're not making any payments at all. Now, again, many lenders will give you the option of full deferment, or they'll give you the option of making interest-only payments or full payments. Some lenders are going to require that you make interest-only payments or that you make a minimum monthly payment. You just want to ask ahead of time so there's no surprises, 30 to 60 days after your young adult starts school. So, ladies and gentlemen, thank you so much for attending. Hopefully the College Financing 101, Understanding Your Award Letter, was beneficial to you. If you have any questions at all or you need any additional assistance as it relates to planning your college career, please reach out directly to your credit union. And again, for any questions that you might have on your award letter, you can send them to me directly at scholarhelp@studentchoice.org. And it may be helpful if you're able to scan your award letter and send it over to me as well, and we'll have an opportunity to review it and reply to your questions either directly through email or even calling you if that makes sense based on your question. So again, ladies and gentlemen, thank you so much for attending. As you are logging out, there will be a survey that pops up. If you can take a few moments to complete that survey, we would certainly appreciate it. Thank you.